Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get more on the market and how to manage all of this. James Abate is Managing Director and Chief Investment Officer at Center Asset Management. Here's my really dumb question. Like, do you sell or is there a level to buy? Like, I don't know a more sophisticated question than that.
I don't know if it's a level. Let's think about what markets are doing, whether it's today, but let's look back at Friday. The selling on Friday was just indiscriminate. We had the highest volume day ever on U.S. trading. ETF volume accounted for about 40% of the volume, which indicates there was a rush to either hedge or delever positions. And I think one of the things that was telling to us is that even the safe havens like consumer staples, healthcare, utilities, even domestic infrastructure stocks participated fully in the drawdown. It told us that even for the short term, maybe we might see some stabilization or a vicious counter trend rally like we're seeing this morning. The bottom line for us is this is a terrific opportunity, for true active management, because we think we're on the cusp of a potential market leadership pivot. We've been in an environment for the last 2 years where it's been the Mag 7 being the only source of returns, leading to some extreme concentration. In fact, we saw a lot of large cap core mutual funds have to change their investment policies to become non-diversified funds because of the top heavy buys of the benchmark. So going back to November, we came out very skeptical of the analog of just following the Trump trade playbook, despite the post-election rally, and stayed that way. But we've had a tremendous reset in prices. We've seen a rally in treasuries that I think, leads to opportunities in certain segments of the market, like the regional banks. You've got treasuries that have prepared their balance sheets, Fed cuts. We're the most bullish on regional banks probably since 1996. I don't want to date myself, because they're going to be growing and really be the leadership of the market, we think, because they'll be financing the industrial heartland build out. So our point to investors is now's the time to have a Main Street portfolio, not a Wall Street portfolio. And that's really a key thing for us.
So what is, I guess, the constituents of that kind of portfolio? What are the themes driving it?
The themes that would drive it are basically regional banks, utilities, other domestic infrastructure plays. I think the first thing to remember and why we were kind of bearish heading into this year was that markets were priced for perfection. You had an equity risk premium that was essentially zero. Credit risk was essentially dismissing any potential of disruption. For us, DeepSeek, the announcement of DeepSeek was the first match that was thrown on an overvalued Mag 7 driven market. The tariffs were kind of an accelerant. So I think the real key thing to look here for is on the other side of this trade, where we do get a rally, I would expect this to be an environment where the Mag 7 does not lead the other side of the sell-off here. And I think that will be confirmation that a Main Street driven portfolio, not a Wall Street driven portfolio, will be the one to lead us out.
But Main Street has also and will be hit. As we were just talking about earlier with Morgan Stanley just downgrading all the banks. Yes, the ones with the capital market exposure get hit first, but the mid-sized banks, the regional banks, they're not going to be spared either.
Well, think about that. Or how much of that is already reflected? Many of these regional banks, whether it's Key, Regions, they're trading at less than book value. Many of them have seen an inflection in the return on equity. Most of the pain in the regional banks occurred when we had the sell-off driven by the failure of Silicon Valley Bank and some of the others. They have not yet been in the growth mode. Clearly, there could be some credit issues on the lower end of the consumer, but the concentration of commercial real estate problems is really dominated in the money center banks. So we would avoid the money centers and really for the first time have an opportunity further down on the capitalization spectrum with the regional banks.
So how do you price in this environment we're in now, James? Do you think it's something that is going to be a longer term issue for this economy?
Well, I think when we saw President Trump announce potentially that there'll be a stay on most tariffs except for China. China is the primary target and going to be the biggest loser. I mean, the fact that the market sold off on their retaliation to the U.S. on Friday is kind of, in a fundamental sense, immaterial. I mean, our biggest exports to China are soybeans, coal, almonds, and other things. I mean, the U.S. owns the asset that China and everybody needs, the U.S. consumer market. The key thing to remember with all of this is that, you know, we should stay away from blaming China. It was the U.S. multinational companies that closed down U.S. production facilities to gain access to cheaper labor and loose environmental concerns. And now they're the ones that have to reap the negative consequences of those technology transfers, as well as the intellectual property.
James, wasn't that the proper allocation of capital? Why produce something? Don't you want to produce it in the lowest cost environment to pass on the cost savings to U.S. consumers through lower prices and lower inflation?
Sure. Would you rather be unemployed and have access to a $79 flat screen, or have a job?
Who's unemployed? We've got full employment, James. James, we've got full employment here. Who's unemployed?
Well, it's the quality of the jobs. It's determining about the competitive edge that you can have as a country. There are security concerns. I think when you look back,
okay, so it's not economic; it's security.
It's both, actually. You have to have national security issues. I mean, let's forget that Chuck Schumer back in 2004.
So the fact that widgets are being made in China, that's a security concern to you?
That's not where Trump is going after. He wants the high value added things like
I haven't heard
automotive,
what he's going after.
Technology, pharmaceuticals. That's where he's trying to gear it up. Toys, other things. Those are not really on the radar.
All the pharmaceutical companies are in New Jersey. James, thanks for joining us. Appreciate it. James Abate, Managing Director and Chief Investment Officer of Center Asset Management. Appreciate it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, let's go to the autos because they ain't getting any love. You got GM stock is down by about another 3.7%. Kevin Tynan is Director of Research at the Presidio Group, joining us to discuss all things auto. Kevin, I mean, how bad can it get for these guys? Like, where's the low here in the stocks?
You know, the interesting thing, Alex, is that if tariffs are a supply constraint for the auto industry, for the U.S. auto industry going forward, the last time we had a supply constraint from 2020 to 2023 was actually the most profitable time for the dealer groups and for manufacturers. So it kind of puts supply and demand, or has the potential to put supply and demand back in balance, add or utilize more of the domestic capacity. And this actually could be a good thing because we're not oversupplied with this narrow margin environment that this industry has struggled with for decades. So it's kind of interesting that it looks like an opportunity because you're talking about tightening up pricing or firming up pricing and expanding margins going forward.
Guys, jump in on that for one second.
Yeah.
But then we've heard you have Ford, I think Volkswagen, also Volkswagen's laying off some workers in the U.S. Ford is now discounting their cars in order to get people in the lot. That feels really different from 2020.
Yeah, well, the difference is it affects where 2020 was supply chain disruption across the board, right? Almost everybody was impacted the same because the supply chain is common through a lot of automakers. This is very different depending on what your production footprint looks like. So for those, right, for example, if you look at U.S. automotive factories in the fourth quarter, utilization was 65%. Right, where you're really looking for 80 plus to be, utilization for your auto factories in this country. So the idea is that you're going to have manufacturers that don't have enough capacity here to ramp up and are going to be penalized by that. And then you have the ability for manufacturers who do have capacity here that is being underutilized to ramp up output to make up some of that difference or those lost units. The way I look at it is this, right? 16 million units were sold in the US in 2024. About 11 million were produced here. So if you think about 5 million units in play, whether they get built or not built, there's the opportunity for domestic capacity to absorb some of those 5 million units. And when you think about it, 2022, which was the most profitable year for manufacturers and dealers, was only a 13.8 million unit market. So this can be profitable for manufacturers on smaller volume. And I think the headline is this takes units out overall, and that all sales are good sales, which isn't necessarily true. This will improve the quality of sales because supply and demand will be in balance.
Okay, that's what I thought too. That's why I'm very surprised that auto stocks have been trading down. Shouldn't this be the tariff environment? Should this not be good news?
Eventually it should be, right? If it goes according to plan, we're at 80% capacity for our automotive factories. The other thing too, and I think, Paul, the burden on the manufacturers, because they have to right size or utilize more of that capacity, that lift is heavier for the manufacturing base than it is for the retailers. The retailers went through this process of supply constraint, fewer units, and have sort of rationalized their cost structure more recently than the manufacturers did, right? They idled plants, but they really didn't take out that capacity. So I think there's a little bit more of a longer lead time to get that production where it needs to be. And that's a global issue, right? Automotive capacity globally is a problem, and some of it needs to come out. So I think you're going to see a different impact on the manufacturing stocks versus the retailer stocks. And at the end of the day, the consumer ultimately just pays more for everything.
That's such an interesting take. Let me add on one more layer. What about the steel and aluminum tariffs, and pretty much tariffs that's the input part? You mentioned that we could maybe absorb about those 5 million cars that were bought that weren't made in the U.S. What's the layer, though, on top of that when it comes to these derivative tariffs?
And I think that's an impact on the supply base, right? You're going to have some suppliers, smaller, and depending, again, what your production footprint looks like, that are very much impacted, where there may be one or few big contracts where margins are razor thin, that this throws everything out of balance. But again, even if you think about that at the materials and the supplier tier 2, 3 going to be a problem, at the end of the day, that's supply constraint. And as you move through the value chain, that impacts the manufacturers differently or the retailers differently. If you think about the US auto market going back, it's least profitable when there's the most inventory. And it's the most profitable when there's the least inventory. So we're moving to this period where we're coming out of a rebuild of inventory back to dangerous levels, I would argue. And that gets right-sized back to a 2-to-1 ratio inventory to sales. And it's actually a good thing longer term. There's going to be some pain right now in the uncertainty. But if it's according to plan, supply and demand come in balance and margins are just better.
Kevin, we've got about a minute left. Does this uncertainty in the auto business impact the changeover to EVs? I'm not even sure where we are there, but is there an impact?
Yeah, I mean, I think that was happening organically anyway. I think what this does, or this administration does, is it takes some of the demand levers out of there, which relieves some of the financial pressure on manufacturers to do a technology that has proven unprofitable. So I think you're starting to see that at state-by-state level in terms of the California Air Resources Board waivers. Virginia didn't go for theirs. There's talk about every other state saying, like, we can't go 100% EV or battery electric and plug-in hybrid by 2035. We're going to lose units to non-carb states.
Right.
So I think you're starting to see that pressure from government back off a little bit and let the market be a little bit more organic, right, and grow that demand naturally.
All right, Kevin. Kevin, great to talk with you as always. Kevin Tynan, Director of Research at the Presidio Group, joining us from New Jersey via Zoom. Appreciate getting some of his time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Think back to the election, to the turn of the calendar year into 2025. Animal spirits. And nowhere did animal spirits run more rampant than on global Wall Street. Let's get some deal making. We're going to have easy money. We're going to have less regulation. We're going to have pro-business policies coming
Capital
from the
markets going to be wide open.
Yep, and let's go rip it. A little bit different tone here today, particularly punctuated by the letter from Jamie Dimon to his shareholders here. Sridhar Natarajan joins us here at Bloomberg News. He's a senior finance reporter. Sri, times have changed, my friend, over the last few months. What are your sources on Wall Street saying about deal making, IPOs? I see a big loan got postponed today to fund a buyout. So what's happening?
Yeah, they're looking for dog walking appointments. I mean, look, the sentiment is honestly captured by Isabel's story today, where if you look at the big take we have out on Bloomberg today, the headline literally is Wall Street is just collateral damage in Trump's trade war. Both of you are right. 5 months ago, when after the election, the biggest reaction in the markets came from these firms indexed to Wall Street, indexed to deal making, indexed to capital markets, who were certain that regulation was going to go down, all the obstacles were going to get out of their way, and it was going to be boom time for their business. The only problem was they were not taking President Donald Trump seriously, or at least President-elect Donald Trump, or the man who was campaigning to be president, seriously, when on the campaign trail repeatedly he talked about his decades-long desire to change the global trade order. Tariffs are not something that's an idea that's been injected in Trump's head in the last week or 2 weeks or a few weeks before that. He's been talking about that for nearly 40 years. The problem was Wall Street refused to take that seriously. Now they're being forced to confront it, and the reaction hasn't been great.
And Jamie Dimon talked about in his letter, right, that there could be irreversible damage if it's not sort of turned around or changed relatively quickly. What did that entail? What was that really speaking to?
And to me, it was interesting that Jamie said that. Again, his annual shareholder letter is something that people look forward to, not necessarily the Warren Buffett letter, but with his stature as the elder statesman in the banking sector, every time Jamie Dimon has something to say, people pay attention. It's a 60-page missive, so most of it was written weeks and months in advance. But there was a lot of changes made in the last 48 hours, and the one that we're all drilling into is his commentary on tariffs. And he's clear there that the longer this goes on, the negative impact will be cumulative. And that's what a lot of people have been talking about. Even if you start trying to change course, you try to negotiate. There was a commentary from a Goldman partner over the weekend who said it's really hard to put the toothpaste back in the tube once it's out. And that's the concern for Wall Street. If you are taking away the critical ingredient that businesses need, that bankers need, that the economy needs, which is certainty that gives you confidence, then what hope do you have?
Did the big global investment banks, just refresh my memory, did they provide earnings guidance typically?
They generally tend to talk about what their quarter is looking like. Okay. But the problem is when they start reporting earnings starting Friday and through the middle of next week, you will see that a lot of the numbers that they forecast, a lot of the numbers they talked about, which was especially relative to trading expectations and even deal-making expectations, they will match them, perhaps even beat them. But nobody really cares anymore because we do not want to know what they did between Jan 1 and March 31st. Exactly. Everyone is paying attention to how badly they will be hit going forward. Morgan Stanley is out with a note today downgrading the entire banking sector. And the breakdown there is interesting. They talk about how someone like a Goldman Sachs, you will see the immediate impact because the twitch reaction in capital markets and deal making is just, it's a snap. Yep. You see it, it's evident with respect to slowing down of loan growth in consumer books at banks or consumers falling behind on their loans. That is still something that's out in the future. And perhaps, if you're able to somehow navigate through this tariff, whether it's a negotiation, not a negotiation, whether he goes away with sort of the worst case scenario or dials it back a bit, that could have an impact on those things. But where you're seeing the immediate impact, just the fact that it is hanging out there, is deal making, is capital markets. And when that is shut, banks and firms that are indexed to that part of the business are going to bear the brunt of it.
Okay, but just in the last 10 minutes, stocks have just turned around. Now you have the S&P up, say 1.5%. You got bonds selling off hard on that back end, kind of out of nowhere. Isn't that volatility supposed to be good for banks?
Turn around is a strong word because yes, if you checked out,
if we're down 4% and then we're up 1.5%,
if you're checked out Friday evening and came in Monday morning and you're down 1.5%, that's still bad news. But yes, if your weekend ended at 6 p.m. Sunday and you were watching Bloomberg surveillance last night and you saw stock futures at down 5%, you started this morning down 4.5%, down 1.5% is not that bad. But again, this is
not
pure
good volatility.
This is not good volatility. This is not even informed market reaction. reaction. At this point, people are just trying to guess, how long can this last? Will there be a flip? Donald Trump himself has come out with tons of messages, including his excitement about meeting the Dodgers at the White House this morning. So maybe that's what's causing the positive market reaction. We just don't know.
All right, we'll stick with that. I think that might be the winning forecast there. Sridhar Natarajan, thanks so much for joining us, giving us the thoughts of kind of how Wall Street's trying to price in some of this uncertainty here from the tariffs.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.